Hi, I'm Jim Kreider, and this is the Intentional Living Podcast, where we have conversations about how to use your resources, your time, your money, your talents, for what's important to you in life in an efficient and effective manner. I'm glad you're joining with us today, and I look forward to this journey with you. In today's episode, I'm joined with Clay Finck. Clay is the host of We Study Billionaires, the flagship and wildly successful show of the Investors Podcast. Now, Clay and we talk through a litany of topics today, ranging from traditional investing to Bitcoin to economics and even the softer side of investing, the emotional part of how and why do we use our money. Now, Clay's a good friend of mine and is a wealth of information, so I'm excited to get to the show. So let's dive in. Clay Finck, thanks for joining me here today. Looking forward to talking to you. Should be a lot of fun.
Well, Jim, I've hosted a ton of podcasts and you've been on a ton of podcasts. So it's interesting to turn the tables and, reverse the roles for this one.
The turntables have. Yeah, this would be a lot of fun. I think you host a small show that's out there. So hopefully this will help get your name out to the crowd and maybe get some increase the viewership of your little thing.
Yeah, hopefully.
Yeah. Well, I'll do what I can. No, well, yeah. So Clay, if you want to just tell us a little about yourself, what you do and where you're at, what you enjoy, and we can go from there.
Sure. Clay Finck, host of We Study Billionaires. In my prior life, I worked in insurance for 4 years and knew that route wasn't what I wanted to do for the rest of my life. And thankfully, TIP had an opportunity come up for their millennial investing show. And I talked with Jim on that show a couple of times. And I recommend people check out those conversations where we talk about financial planning, Bitcoin, money, everything else. And so I was host of millennial investing for a year after I transitioned out of insurance, and then been a host on We Study Billionaires for just over a year now. And it's been the time of my life. And then Jim, we've gone back and forth too on the community I helped TIP recently launch back in April. It's called the TIP Mastermind Community, and we have just over 80 members there. And I'm kind of just helping many of our audience members just kind of get connected with each other. Just another learning avenue outside the podcast where people can get more personalized information from others, or just kind of keep in touch with others on what's happening and how others are managing their portfolios. So it's been the time of my life working with TIP for just over the past 2 years.
Yeah, this will be fun. You've had an opportunity to talk with so many smart people and glean so many nuggets. That's where I'd like to sort of camp on that today. It's just hearing some of your favorite conversations and thinkers and key takeaways that you've had over the years. Let's go there. So I guess first off, for those who don't know, what is the Investors Podcast and We Study Billionaires? Like, what are you usually talking about? What does that look like?
Yeah. So TIP has sort of gone through these different phases. Initially, it was Preston and Stig. They started the We Study Billionaire show in 2014. And, for years, it was just a weekly hobby almost. And then all of a sudden, the podcasting space matured. It developed. More and more people started listening to podcasts. Advertisers started to get interested, and Preston and Stig realized the incredible asset that they were sitting on. So around 2019, 2020, it started to turn into a real business for them where they could start hiring people. They could start, developing a process for taking on advertisers and building a business around the podcast. And then that's led to TIP launching other shows. It's led to they have a newsletter now that has over 35,000 subscribers. So the shows outside of We Study Billionaires is obviously Preston Pitcher Show, Bitcoin Fundamentals, who you just had on your show, one of the first episodes. And then we have William Green hosting our Richer, Wiser, Happier series, where he brings on, these, legendary investors, and many of them are billionaires that he's developed relationships with for the past 10, 20 years. He had a long career as a journalist interviewing these types of people, the Bill Millers, the, Peter Lynch's of the world. And so he's been an incredible asset to TIP in addition to our team. And then we also have a millennial investing show that Jim, you and I chatted on. That's on a different podcast feed. But yeah, on the We Study Billionaires feed, we mainly talk a lot about maybe just business in general, or we talk a lot about stock investing. So that's mainly Stig and I nowadays. And yeah, and then Preston and William show are also on that same feed too. So subscribers to that feed are kind of getting a host of different viewpoints, perspectives, and such.
So as you let's go here actually. Where so you like me, I live in this weird dichotomous world of Bitcoin and thinking about macroeconomics and monetary and fiscal policy. I think that makes a lot of sense and it's fun and intriguing. And I think if you do not pay attention to these things, especially if you're working in the money industry, you are sort of burying your head in the sand. But also, so I live in this place, but also I'm a financial planner in a very traditional sense. I'm a certified financial planner, and most CFPs out there tend to sort of bury their head in the sand, and they say that, hey, if you're considering the macroeconomic environment, you're trying to time the market, and that's an evil thing to do, and you should be on autopilot in totality. And the moment you look up, you're foolish. So for you, it seems that you also live in a different, but also in a dichotomous world of very staunch traditionalism of investing. You're talking to these people who have built businesses, and these you're talking about like valuation of company stocks. But then also,
Mm-hmm.
I mean, you and I just hung out for a week in Telluride, Colorado, with a bunch of crazies talking about Bitcoin and macroeconomics, which is they're certainly not in contrast. It can seem that they are. A lot of people who, especially if you're entrenched in the traditional world, you might think that Bitcoin is the antithesis of that, which I would argue it's not. It's actually going to be a restoration of the health of that. Um, but again, the perception is these things are conflicting. So for you,
Mm-hmm.
how have you navigated living in this traditional sense, but also living in this like I own Bitcoin too, and where to put your money in those
Mm-hmm.
conversations? And is it when you have these conversations with traditional managers, what's going through your head when they talk about ways of viewing money in traditional sense versus like viewing it as a Bitcoin or press and pitch side of things? That was like 8 questions in one.
Yeah. Yeah. I love that you went this direction because you and I are definitely in those worlds where you're talking with financial planners and they want nothing to do with Bitcoin, and I'm talking with fund managers who could care less about it. And you know, it everyone has their own perspective on it. One of the interesting things is, I have this mastermind community that I'm leading for TIP, and many people in the group do own Bitcoin, but like the people joining, they joined because they want to talk stocks, and it's just something that is intellectually stimulating for them. It's something they enjoy doing, and Bitcoin may or may not be a part of that. And I mentioned to you earlier that Bitcoin, it's kind of this thing for me personally, like it's a part of my portfolio, and it's kind of just a set it and forget it type thing. I don't care if it drops by 50% tomorrow. I don't care if it goes up by 50% tomorrow, although that would be nice. No matter what happens really on the upside or downside, I plan on just hanging on to it for the long run. And that's kind of the way I view it. And many people in the group that I'm talking to kind of view it the same way, in that they believe in it long term, but they don't want to have 100% of their assets in this one thing. And that's kind of the camp I'm in. Like, I want an investment approach and investment style that allows me to sleep well at night. It allows me to, not have to worry about checking my investments all the time. So for me, that's led to me having a portion of my investable assets in Bitcoin, and then a good portion is also invested in stocks. And that's the approach I feel like is most appropriate for me. It's what I'm most comfortable with. And I just honestly enjoy looking at companies and talking about companies with others. And, um, being a host on the show, I've wanted to be very mindful of, not being so not thinking in such absolute terms and thinking that Bitcoin's going to take over the world, or a certain company is going to do amazing. So diversification, I think, is something that's really important for me. And it's just an approach that I think just works well with, what my goals are, what my temperament is, and where I want to be 10, 20, 30 years down the road financially. And then also on the macro point of view, I thought that this might come up today, so I jotted down some notes on some points I wanted to make related to macro. I think it's certainly important, and it drives many things, but determining how the economy is going to act in the next 1, 2, 3 years, or where interest rates are going to go, and then how that ends up impacting markets is incredibly difficult, if not impossible. And you know I think in 2021, if you would have told a lot of these macro forecasters that interest rates were going to be 5% in 2023, mortgage rates were going to be 8%, the Fed would have sold off $1 trillion off their balance sheet. I mean, they would have told you you're in crazy land, and like that would just destroy the markets. Yet, stocks, haven't crashed like they probably thought they would. And, these simple correlation causation, if X then Y thinking, can be very dangerous. And I wish life were that simple and the world were that easy to predict. But we live in a very complex world, and that's just something I've kind of come to terms with this year. And yeah, I just try and focus on things I can control and things I feel like I have an edge in. And part of that, when it comes to like investing in stocks, is just finding a handful of really great businesses, buying them at what I think are reasonable prices, and then just hanging on to them, because I think we just live in a really short-term world where people are just really impatient, and a lot of people aren't willing to buy these and hang on to them for a really long time. And then another point I wanted to make is that, if you look at like the best investors with like credible long-term track records, and say you pull 20 or 25 of them, you might find like one or two that achieve the results they did based on making macro predictions. Like Stan Druckenmiller is one that comes to mind, but like most of the other ones were almost all of them, I would say, were stock investors. So I think that also points to how difficult it is to predict the macro. Well, I guess not only predict the macro, but also predict how that impacts the markets, because tons of people have made accurate predictions, but in terms of how that affects their portfolio, it just makes it so much harder, in my view.
Yeah,
So
I mean
yeah, it's just my general
it's not
thoughts on some of the
too
things I've
it's
learned.
not it's not too hard to be right eventually. I could be right eventually about most
Mm,
things. There will be a flood in Texas. It's like, all right, like 15 years from now, it's like, I told you so. It's like, well, dude, well, if I've been sitting in a raft with a life jacket on
yeah.
for the last 15 years, I've wasted a lot of time. And that's, I mean, Warren Buffett, a very
Hmm.
popular saying of his is what the market can stay irrational longer than you can stay solvent. I probably just butchered that, but
Hmm.
yeah, it's this thought of how not only how right are you, but how right are you in the time frames you're considering, and how do you place that into what you're owning, your yes, what you're owning, but also like where your head's at. I like that you mentioned that you want to be able to sleep well at night
Hmm.
as well. That's something that I speak to regularly. Is like you're not a spreadsheet or in a math equation. Like we're not trying to optimize you as an Excel document.
Hmm.
You're a person with emotions and convictions and with desires and goals, and you have to consider these things. That goes into like how do you invest. It also goes into like debt. It's like, hey Jim, like I have this I had this debt. Should I pay it off? And it's like, well, we can look at the math. We can break that down. And sometimes that's really important. Like if some people really need to, we have to optimize spreadsheet wise. Should you pay off this debt or not? But a lot of times it's less that. It's more of like, yeah, look, mathematically, you shouldn't pay off this debt because of X. Like the risk-free return right now is 5%, and the your interest rate on your debt is your mortgage is 2.5%. So yeah, math would say don't pay that thing off, keep that as long as possible. But yeah, if you're sitting here, it's like, look, I just don't like debt, and I can afford to pay it off, and it really wouldn't change my life at all. It's like, well, cool. Well, I hope you sleep well, and let's get that thing taken care of. So I like we've got to sit on that with portfolio as well. That's where people get caught up. It, gosh, there's a study that was done several years ago that was comparing investment versus investor returns, and there was a
Mm.
pretty good gap between the two. And that gap they've labeled the behavior gap. The behavior gap
Mm-hmm.
is why is there this chasm of a few percent between these investments, but then the people who invested in those underlying investments, and that can be related to behaviors. And that's where it's really important to think
Mm-hmm.
through. If you're going to buy something, you better have high conviction of what you're buying, or at least be willing to stay put. If otherwise, you're going to be like someone who goes, you can go to you go to Six Flags or Disney World, and you get on a roller coaster. You're sitting outside of a line of a roller coaster, and you see that, wow, those people look like they're having fun doing it, and all my friends want to do the roller coaster. I don't really like those, but I guess I'll do it myself. And you get on, and you start going up. It's you're going up this thing, and you start going on this massive dip, and you realize as you're going down or over the first loop, you realize, this isn't really for me. And you take off your seatbelt. That's the worst time to take off your seatbelt. So you want to think through: is this something I can tolerate prior to getting on the ride? Now, obviously, this
Mm-hmm.
equation or this analogy falls apart when we introduce like Enron. It's like, look, if you own Enron, I don't care if you're going around the loop or not. You probably should go ahead and bail. But if you're sitting on something that's relatively sound, you don't
Mm-hmm.
you want to consider, like, should I take off my seatbelt right now and risk massive hurt, or why did I buy this thing? And it would do people go a long ways and just help bridge that gap or close the gap of this behavior gap if we just thought through not just the investments but also yeah, how sweaty will my hands be while I'm sitting on this roller coaster. So yeah, again, you're not
Yeah.
you're not an equation, and I like that. You're a
Yeah.
good guy, Clay.
You brought up some really great points there. One of the interviews I had is with Chris Mayer. He mentioned that even the great investors, they trail the market one third of the time. So, say over a 10-year period, they might drastically outperform, but there's going to be 2 or 3 of those years where they're going to be underperforming. And that points to the behavior gap you have where people tend to chase whatever's hot and then they bail on whatever's not doing so hot. So they're just like making their decisions based on whatever prices are doing, when in reality, the great investors, they understand a process, they're sticking to it, um, and then they're sticking with that process. When things aren't going their way, they're sticking with it and understanding, why. Essentially, they have a thesis on why it is their investments are going to work over the longer term, and yeah, it kind of points to what I was saying earlier, where people tend to be too impatient and they tend to make changes too often to their portfolios and just kind of uh, fall prey to all these biases that you're mentioning.
I think there's a nice equilibrium of conviction and patience, but also agility. That's in the interview with Preston. I spoke to him about this gentleman who has been managing money for since the early 80s. And I was talking with him a few years back, and he mentioned that his most of his clients are sitting in like 80% bonds, 20% equity portfolios. And I asked him about his thoughts on the risk of owning such things, and he said that, well,
Mm,
I've done really well. I've been doing this since 1982, and that's where,
hmm.
yes, conviction is good and all, but it better be founded in something, not just recency bias, but actual a good a sound thesis. So yeah, there's this healthy marrying of agility and critical thinking, and it can't be based off critical thinking one time, based off of one thought I had, but does this still make sense? And that's where investing is really interesting. you run into so many biases. Something I hear regularly for especially like a new client will come on and we'll be looking at their portfolio that they've owned prior to working with us. And a lot of times they'll own something that they've owned for a really long time. And this thing, maybe it's down a
Mm-hmm.
lot. Maybe it's a stock they bought several years back and it's down 40%. And it's like, hey, man, I really want to, I don't want to sell it yet. I just want to wait for that to get back to break even. And then we can go invest it in
Yeah.
something else. It's like, okay, one, we can look at this from so many directions. If it's in a taxable account, okay, well, we can harvest the losses now and offset capital gains or offset some earned income. Like, why? Like that makes sense. Two, do you want to own this thing versus owning something else because you think that during this time frame, this thing that's down 40% will outperform the other asset that we would otherwise sell it into? Or is it because you are so anchored into getting back to your initial purchase price that you'll wait out whatever time it is? Because then we are back to a simple math equation. Like, will X outperform Y over this time? Again, we don't know, but we're guessing. It's like, yeah, I own this hot pile of garbage, but man, I want this thing to get back to where it was so I don't feel bad about myself. Again, there's just so many
Mm-hmm.
weird biases here that we succumb to. That's where you've had an opportunity to talk with so many smart people who I think a big part of this is being aware. Like I know for
Mm-hmm.
me, I know that I'm not that smart about most things. So I try not to have these biases because I at least am familiar with what I can succumb to. And I think it's a lot of it. It's just being aware of what your downfalls can be. And I think that's a big part of being smart is realizing what you're dumb in a sense.
Yeah.
And I think those are some
Yeah.
of the hard lessons of life is learning these things.
Yeah. Is it the Dunning-Kruger effect, or it feels like you know a lot in the early stages, and then it like totally drops off, and then it goes goes back up? Speaking with so many smart people, I think it has a way of really humbling you and um, just making you humble in what you think you know about the world and the assumptions you make, because people want to feel like they know what the future holds, and they want to, follow people that make these predictions on what's going to happen, when in reality, we really don't know what's going to happen to a lot of things. Um, yeah, and it really just makes me humble. And the fund manager you mentioned with the uh, that was heavily weighted towards bonds. It reminds me of, kind of the inertia of people kind of find a process. They find out that process works, and then it's just like people have a really tough time sometimes to adapt when it's absolutely necessary to do so. And there's so much evidence that they need to rethink how they approach things.
I heard yesterday I was listening to a podcast and the guy was I don't remember how it came up, but he mentioned just this ability, like over time, what wisdom and things you can glean. And what he mentioned was when you're young, you think that you're real strong. Like I have my oldest, he just turned 6 this week, and he always talks about no, all my boys regularly. They show me their muscles all the time and how strong they are. So when you're little, you think that you're stronger than you are, and then there's a point in life that you realize you're not as strong as you thought you were, and you learn some lessons that way. But then you also get to a point later on in life you realize that being really strong isn't really that important. And I think those are different phases we all go through from muscles, but also like these other things we put such an emphasis on, like, oh, whatever, I'm going to be rich. It's like, man, if when I zoom out, maybe I don't have as much
Mm.
as everyone else does. And then you go later on, it's like, man, these things aren't even that important. Like, why did I chase this? And just really, really sobering, especially, yeah. I mean, there's some wealthy people who are really happy, and that's awesome. There's other wealthy people who are miserable, and that's sad. But really, what it comes down to is you can
Hmm.
learn early that all that stuff at the end of the day is not going to make you happy or miserable necessarily. Like that's a good lesson to learn, but also recognizing other lessons, like being agile enough to recognize, like, okay, I've owned this thing forever, therefore it'll keep doing well. Like, man, you need to progress your frame of reference around these things. So, yeah, I think there's just it'd be I'd love to see people, and you're in an amazing position that you can glean wisdom from other people that having to learn these lessons the hard way yourself. And I try to keep an open eye where I can glean those lessons themselves. That way, I'm not having to encounter and learn everything the tough way. What are some of your favorite takeaways from conversations you've had where it's like, ooh, that was a good lesson to learn. Maybe it's a hard lesson or a fun one, but I'm gonna put that one in my back pocket. I don't have to navigate that myself, but I can at least take the lesson away. What are some of your favorite things you've got to glean over the years?
That's a good question. A lot of them are related to what we mentioned of just like being humble and being really mindful of what your biases are, and um, just being humble in what it is you think you know. But I'm reminded of a conversation I had last week with a fund manager, and it kind of reminded me again just on the true power of compounding and how it relates to investing. And I'm sure you're aware of this, and with all the people you speak to, and they want to do all these things today, which is like great, but also recognizing the power of that long-term compounding. So it's kind of marrying the two of what do you truly value in life, and then recognizing the sort of rewards that compounding can give you later on down the road, years ahead. And I'm sure that mixes in with a lot of the conversations you've had, and we've talked about it on the millennial investing show. But the compounding example he gave me, he uh, he had said that compounding is convex on the upside and concave on the downside. And
Hmm.
I asked him to sort of explain what this means, and he gave an example of, say you have two investments, they both start at $100. The first one is an incredible investment. Say you pick a stock and it compounds by 26% for 10 years. And then the second investment compounds by negative 26% for 10 years. So uh, over that 10-year period, one investment ends up becoming a multi-bagger, and then the other one essentially becomes like a zero. But since compounding is convex on the upside and concave on the downside, your upside is essentially unlimited when an investment does well, and it's limited. The downside is limited to whatever you invest. So even though one investment is almost a zero, you still end up getting an average return of 17%. So even though you only had a 50% hit rate, you still end up with a fantastic result because of the asymmetry that compounding offers. And that's just, when you're putting together a portfolio and just thinking about individual stocks, like I am, like many of the guests I have on are, it's just amazing to think that, you know, you need to be humble, and you don't have to be right 100% of the time. You can even be right 30 or 40% and still end up with a fantastic result if, you know, individual stock picking or picking investments is something that's in your wheelhouse and something you're interested in. But yeah, that's a one lesson I found really interesting in a recent interview, at least.
We think back in remember when the COVID shutdowns happened. Sports were put on pause, and traditional means of gambling were put on pause, and then suddenly we had this massive rise of people utilizing, uh, just investing apps, and the rise of meme stocks and people speculating the market. What are your thoughts on that? Just like, anyone doing some investing versus how educated should you be when like, what's the difference between investing and gambling, and where does that crossover take place?
Oh man. Yeah, I mean, most people investing during that time period were essentially doing gambling. But yeah, I mean,
I think there's a reason you saw this correlation of traditional gambling go down and rise of these meme stocks hit in tandem. So sorry,
yeah,
keep going.
yeah, I mean, if you're buying, say, individual stocks, or you're buying options or whatever else, then you need to obviously have a firm understanding of what the heck it is you're buying. So if you're buying options, you need to understand how a call and a put option works, and understand that in some cases there's 100% downside in a month or 2 months or however long the duration is. When it comes to stocks, I mean, for me, I've just read so many books on the subject that I can typically just look at a company and disqualify at least 95% of them just because I know exactly what I want. I know the type of kind of risk return profile I'm sort of looking for. And, just looking for just filtering out things like highly indebted companies or uh, maybe companies of a certain size. I don't want to buy a lot of the mega caps oftentimes, and looking at the managers and like are they just being compensated ridiculous levels relative to how big the business is. That's all too prevalent. And then stock based compensation is something that is all too prevalent. And I mean, for someone that's like just getting into this stuff, I mean, you should most likely limit, some of your individual picks to a small portion of your portfolio. And like, the tried and true methods are what should be like the foundation of like most people's portfolios. Things like an index fund, an S&P 500 fund, things like that. Um, and yeah, I mean, yeah, if you it's really hard to distinguish between investing and gambling because it's just all totally subjective, and there's only so much you can know about a company. But under I'll also mention that the market is the always has a way of humbling people. So like, getting that experience of losing money in the markets is like so humbling. And that happened to so many people in 2022, 2021 after the COVID rise. And there's so many insights that can be gained from that too. And almost all of the really good investors went through those periods of having to learn things the hard way rather than learning them from a book or a podcast.
Yeah, there's some lessons you just got to learn the hard way. One of the lessons I learned several years ago, um, I bought a company, did really well. It was nothing for the longest time, just sat flat. And one day I checked my account, and suddenly this thing within a week, like 5x, did just incredible. And unfortunately, at that point, we were within days of it reaching a place of long term capital gains versus short term cap gains. It's like, all right, man, like I don't love this company. I haven't loved it in a bit. I want to go ahead and sell this, but if I literally just wait a few more days, I'll be able to take advantage of long term cap gain rates, and that'd be more fun. I'm not making this somehow. In the few days of waiting, this company went bankrupt. And that's a tough lesson of, that's why did you buy something in the first place? Do you still have that thesis behind it, that same conviction, or is your conviction changed? What are you anchoring this position in? And what is driving owning this? And for me, I let the tax tail wag the investment dog. I didn't like the investment any longer. And I thought it was at that point overvalued, and it turns out it was. But again, I let one way of thinking trump a more sound way of thinking. Those lessons, that's one of those lessons you learn the hard way. And man, it stuck with me.
Mm-hmm.
Yeah, it just worked out perfectly to be absolutely painful.
Yeah, I think another lesson I've sort of seen or learned is the companies that get people's attention often tend to be like just very risky picks. Like some of my favorite investors that I follow, one of which is Chris Mayer, wrote a book called Hunter Baggers, which is fantastic. One of his rules is he's not going to buy a unprofitable company, because if a company can't make money from its operations, then it either needs to receive financing through debt or through equity. And whenever tough financial times hit, it's really hard to do those things, and it puts the business in a really really tough position. And if a business somehow has a way of like marketing itself and everyone's talking about it, call it a Zoom or whatever else, then there's probably a reason for that because the company might be issuing shares to essentially the public, issuing shares to retail investors, and then these managers are getting extravagant compensation packages. And it's just ironic that the companies that people want to talk about oftentimes tend to be unprofitable. And it's almost like a situation where it almost is gambling, where you need like everything to go right in order to make any money. And then find so many of these unprofitable companies end up dropping 80, 90% during a market correction. Um, yeah, I always turn to I don't know if you've heard of Chuck Ockery. He has what he calls his three-legged stool approach of he wants to find a great business, which means a great business to him is a business that earns a high return on capital. So when a business reinvests in itself, it essentially earns a high return, call it above average, which would be above like 10, 15%. Then he wants a great management team and a long runway for growth, and that's essentially oftentimes what I'm looking for when I invest in a stock. Is like, does this business have a track record of performance? And oftentimes a stock continually outperforming the market is a sign of, hey, they're doing something right. Kind of the thesis that winners tend to keep on winning. And if a business outcompetes its competitors over the past 5 or 10 years, there's probably a good reason they're able to do that. And it's going to be really hard for business to jump in and disrupt that. And then, the management piece, you want managers that have skin in the game, and they, essentially they're financially incentivized to have the share prices do well over the long run. If they've owned shares for the past 10 years and they've shown that they're effective managers, and that's also a pretty good sign. And then, the long runway is also important too, because if a business can reinvest in itself at 20% over a really long period of time, that's where you start to see that sort of compounding magic. But this is definitely much different than a lot of the discussions you're going to have about Bitcoin and macro and all this stuff. So yeah, it's kind of the world I've been diving into.
Yeah, I think a lot of people, when they think of a financial advisor, they picture me behind like a wall of monitors and watching the stock market. And that's like the last thing that I do. So, but it's still fun to think through and talk about. And yeah, I certainly pay attention. And I am more macro driven, just how I work, but also I like to come back in
Mm-hmm.
and look at companies. I think it gives I think looking at individual companies can get you a good pulse on how the market's doing, and also it's I think there's a place of achieving alpha. I think it's possible. Obviously, people have done it. It's really
Mm-hmm.
difficult, and I recognize I'm not smart enough to achieve alpha regularly, especially by switching strategies all the time. Like, it's not going to happen. You better have high
Mm-hmm.
conviction over a prolonged period of time in order to have a chance of doing this. Otherwise, you're sort of if it happens, it's probably by luck. um,
Mm-hmm.
with investing, it's interesting. I think we it's so easy to forget that when you invest in the market, you're literally buying companies, and we lose touch with that. Like, oh, I'm buying this stock, and the stock's going to
Yeah.
go up, and that's where like value investing, these sound principles of investing. It's like, does this company make money? It's and a lot of
Yeah.
times it's maybe
Yeah.
not the sexy thing. Like if we put it back to a small business, like it's a lot of times like these people who are like blue collar, millionaire next door. It's a plumber, it's a
Mm-hmm.
welder. I talked to someone recently who it was a machining company who recently sold to a large institution, and for a lot of money. It's not the sexy work. It's companies that make money consistently over a prolonged period of time. When you think of small businesses,
Mm-hmm.
that's what you want to own. Versus, I mean, my grandparents, something they always talked to me about when it came to business was uh, not just playing business. And they would say how they were successful in owning a few different businesses. They mentioned how so many of their friends and people they would observe would just play business. And the moment they had a fun idea, they would
Mm-hmm.
run with that fun idea, and they would quickly think of like, ooh, what do I want my logo to look like? And ooh, those would be neat business cards. Ooh, that would be fun swag to have. That'd be cool, and we could have this event. And it's like, but does that make money? How are you going to reach a place of
Right.
profitability? And you observe that. Like I love talking with people about like business owners themselves and how do you reach a place of profitability. And it pains me to see when I have friends who you realize that, man, they're just playing business. I don't think this is going to survive. Not because they have a bad idea. Like, was it 80% of businesses go out of business in their first year, and then the of those that survive, like 80 or 90% of those don't survive the next 3 years. And I think a lot of times that's not because it was a bad idea. I think a decent amount of them are. It's like, dude, you shouldn't have started that in the first place. Like, no one needs
Mm.
whatever sweaters for dogs. Like, it's bad company. Um, but like
You made some
the
great
good
great points there I want to jump in on. Like you said, stocks are real businesses. Like people are so detached when they're on their brokerage app, clicking buy on some ticker that's gone up recently. Like Jim, if you were to go out and buy another financial planning firm, which is I'm sure it's something you've thought about or something you've looked into doing. I mean, you'd look at, how much has this firm earned in revenues over the past few years and what are those earnings? And you probably wouldn't be interested if it was deeply unprofitable. They were constantly issuing debt. Yet so many people are going out buying something just because the stock price has gone up, regardless of what, regardless of how the actual business has performed. And, in the short term, the stock price is essentially driven by just sentiment and hype and people jumping in and out and all these momentum traders. But over the long term, it's the actual business that's going to drive the performance of the stock. And just again, like so many people thinking short term, trying to chase, whatever's gone up recently when you get anchored in these fundamental principles of what drives value creation is when you can start thinking about, achieving sustainable, consistent long-term returns.
Yeah, that's are you building or investing in a company that actually makes sense? Is it beneficial to people? Is it profitable? Is it sustainable? Does it have a moat? And if you can't check those boxes, what are you buying? You're probably buying hype. If you're building a business that's like that, you're probably just playing business. Again, if we're just looking at a small business side of things, I think a lot of the business I run into that failed again, not because it was a bad idea, not because they were making, whatever, like I mentioned earlier, like sweaters for dogs or something like it's probably that's a bad business. Don't start it. Or, something like that, goofy. It's like, no, that's a good business. But a lot of times those fail not because it was a bad business idea, but because they were caught up in the wrong things. They wanted to play business, or because their personal financial side of things was not able to support and sustain their business. Like when I started my financial planning company, we committed to not taking any income for minimally 1 year because we had to make sure that we had revenue to put back in the business. Like there's a little strip mall down the street from my house that has an insane turnover of restaurants. And over probably like a 4 month period, there was probably 5 or 6 restaurants in it. Some of those restaurants literally were there for 2 weeks, which is incredible. If I go to a restaurant, Kendra and I go on a date and we love that restaurant, we say, "Ooh, I want that to be our new date spot." We don't go on dates twice a week. So even if they get someone who goes to the restaurant and they love it, they're not going to get the repeat business. Like
Mm-hmm.
I don't understand. These people put up a sign and redid the kitchen and all that stuff, and literally what gave themselves 2 weeks of operating capital. Like it could have been the best restaurant ever, but they didn't have the personal side of things to sustain it. They didn't think through this. So again, I think this overlaps with large businesses you can invest in. Like, what are you actually building here? Are they playing business? Are they is it built up on hype? That's where, I mean, yeah, there's this detachment of small business. This is a detachment of like, wow, your color scheme on your business cards looks fantastic. And that's exciting for a moment. Then you realize it's just a bad service or product. Same thing with a large business. It's like, oh, wow, that ticker's doing well. You should go buy this ticker. And it's like, well, what's the company? I don't know. Like I can't remember what it was, but I remember a case several years back where there was two companies that had very similar stock tickers, and suddenly
Oh
the one that
yeah.
was the different one just skyrocketed. No one knew why. No one knew why this company. It was such an obscure company, but they realized like, oh my goodness, because it was one letter off of this other one. So everyone was buying this company. No one knew what it was.
Well,
Uh,
well,
yeah, that's
like when the coronavirus hit, sales of Corona just like skyrocketed. Just there's so many weird things that can happen, and yeah, like you mentioned, sometimes people go out and buy the wrong ticker when they realize that like big news hit a specific company, but they go, yeah, just crazy things. I'm sure you've seen in terms of the stock market.
it really enforces people are funny, and yeah, we're emotional, oftentimes illogical beings, and it can lead
Hmm.
to some fun stories. not so fun if you're on the receiving end. But that's where it helps also to take a step back and not not get too wrapped up in the moment, and then also being able to all right, that hurt a lot. What can I learn from this? And I think if you can get both of those, you'll survive another day to keep swinging. And unfortunately, it's really sad to think through the people um, who don't between those two things, who get wrapped up like, this is too devastating, I can't keep going. That's one of the biggest reasons I got into working in personal finances. I mean, money is the number one cause of divorce. Every year the American
Mm,
Psychology Association has done a poll. Money's been the number one cause of divorce, and it's also one of the top causes of personal stress and suicide. It's like, man, like, if you allow this thing to bog you down and to beat you up and pull you apart, like, that's sad. It's common, but you have to
hmm
zoom out, like, really what's going on here. And
mm,
like a few weeks ago, I I've been sprinting really hard for several years, about 8 years. I've just been running really really hard, and it sort of hit me recently. So like 2 weeks ago, I realized I felt like Forrest Gump. In Forrest Gump, he just takes off running. He felt like running. He just started running, and he does this for a long time. And eventually, one day he just stops. He's like, "I'm pretty tired. I'm going to go home now." That hit me like 2 weeks ago, and I was like, "Man, I'm really tired." And I was talking to Kendra one night, and this it sort of led to a. I don't get stressed very often, but it led to a brief moment of stress. And Kendra and I
mm,
were laying in bed, and I was like, "Hey, babe, like, you've got my back, right?" She's like, "Yeah." I was like, "Good or bad?" She's like, "Did you do something wrong?" I was like, "No, I just sometimes I just need an I just want to be reassured." And
mm,
yeah, just zooming out, like seeing my wife, my kids, it's like, you know what? If something goes bad here, like, we'll be okay. And I think that it's where even stepping back and it's like, yeah, get doing, people pay me to take care of their money. That's really important. But I care about my clients more than I care about their money. Obviously, I mean, I've studied really hard and I work in this a lot to do well with their money and to care about it. But I care about people. I'm like, it's really important. Going back to
mm,
these like anchoring and why are you doing things. I've had so many conversations. I've probably worked with about I would guess about 40,000, probably a little bit higher than that now, people over the years with their money. And it's really sad how many people even were successful financially, but missed the whole mark with why they wanted to do it. And you have to go back and revisit that.
mhm,
Like, Kendra and I, Kendra's my wife. We have 4 young kids. It's like, yeah, we want to do well financially. We want to be able to give generously and spend time with each other and those sorts of things. It's important for us. But if I say, hey, I want to be able to retire early so I can go backpacking with my kids before they're old and have jobs and can't take time off work, I want to have money so I can do that, whatever. But then I sacrifice my children on the altar of having future financial success. What's the point? Like right now, it's like, hey, dad, can you read to me? It's like, sorry, son, I got to go to work so I can spend time with you later. It's like, well, gosh, you missed the whole point, anyways. And yeah, it's where you know thinking through this from an investing perspective, like, why are you buying what you're buying? Has that thesis changed? And if so, like, how's that changing with you? But also from a life perspective, why are you doing the things you're doing? Has that thesis changed? If so, or if not, you better dig in and not just think through the base level. Like, I'm buying this thing because of surface level reason. Like, why are you buying this? Why are you making this decision? And I think that people would do a lot of good by asking why more, both on investing and bigger picture.
mhm. Yeah, I recently had Shane Parrish on our show, and I can't remember the exact quote he had, but it was like, it's one thing to achieve what you set out to achieve, but it's a whole nother thing that people maybe sometimes don't think about. Where did you are you working to achieve something that you actually want to achieve? We feel good about achieving something, but if you want to achieve some sort of net worth goal, and hey, that's cool, and not that many people can maybe achieve that level of wealth, but did it come at a sacrifice to all these other things? Because I think people think about money so often and set kind of money goals because something you can point to, and it's a number that you can like see. You either hit it or you don't hit it. But then there's so many other things that aren't really quantifiable, whether that be spending time with your kids, spending time with your wife, um, and doing those other things. that are also important. You know, as Shane, he's very successful with his business, his finances and such. And, you know, him, Shane, and then Preston Pish is the same way, where you ask them what's important to them and they just say their family. And it's like, you know, when you look at someone like them that says, you know, money's not the most important thing. Obviously, it is important, but there's many other things in life that um, are likely more important to most people.
Well, money, one of my, a vague definition of money I would put on it is a means of communicating, storing, and transferring value across space and time. And I think a big problem that we have with money is the communication aspect. And I think that's a big reason that you have divorce and money so highly related, is because money is meant to communicate what's important to you. And suddenly, if your money is
Mm,
being spent on one thing and your spouse thinks that money should be spent on other things, you are saying with where your checkbook's going is, this is important to me versus this other thing. And suddenly, like, oh, well, that's, you're putting out these signals of value, and you are tangibly voting what value is, what you place value on. I think if you, yeah, again, show me your calendar and your
mm,
checkbook, and I'll tell you what you're voting with your resources
mm-hmm,
are important for you. And unfortunately,
mm-hmm,
again, there's a lot of people have things that are important to them, but their resources, their time, their money, their talents are not being used in tandem with where their heart or their mind or their words would say it's important to them. That's why a lot of people don't realize that until it's too late. Like, man, I really want to, how many people on their deathbed are like, I wish I'd made more money versus like, I wish I would have spent more time with my kids. It's like, dude, like make that vote now. And
mm-hmm,
yeah, that's the purpose of a goal is to inform the best next step. It's not to corner you in to have to continue to pursue this one thing. I understand, like, your goals will change. Like, Clay, I bet your goals today are different than they were 5 years ago, and 5 years from today, they'll probably be different than they were than where they are right now. That's fine. That's expected. And again, the purpose of a goal is not to say like I have to do this thing now. That would be sad. If you feel, I think that's why a lot of people don't set goals, is they feel if they do, suddenly they are pigeonholed into doing this one thing that might seem obscure in a few years, and if they don't, they didn't reach their goals. When setting a goal and saying, you know what, I'm taking a guess as far as what I want, but man, I think this is what I want right now. I will start pursuing this, and taking action that aligns with this. And what's really important, I believe, is to make sure that you're asking the why behind a goal. I want to make X dollars. Why? Because I want to be able to have a nice house. Why? Oh man, because I want to be able to entertain people. Why? Because it's important that my kids are around, that we spend more time with them. Like, oh, so what you just told me in all of that is you want to make sure that you have time with your kids and your family. The house is just a means of facilitating those moments and memories. And the money is just a means of obtaining the house. But really what we're after here is moments and memories with your kids. Like, how do we pursue that? And allowing money to serve those things, but not losing track of what ultimately you said is important to you. And that's, I know we're way off of talking through company valuations and stocks, but again, we go through these conversations, like this really comes back to, and like, yeah, let the resources serve these other things.
mm-hmm. Yeah, when it comes to the company stuff, like the community I'm running, like I tell people that join, like you don't have to be analyzing individual companies. A lot of times you can hit your financial goals with just these basic, you know, investment foundational principles. But these people just absolutely love this stuff, and I I enjoy you know, chatting through it with them too. But to your point about you know, money as a means to communicating value, um my conversation, it reminds me of my conversation with Shane Parrish and how so many of the decisions that people make are like totally unconscious, and it's driven by like almost like our biological hardwiring. Like people will go out and buy like this expensive car because it like shows status, and it like gives them the approval of others, and it's like a very external viewpoint. But if you get down to like what it is do you truly want, and you know, how can you use money to, you know, facilitate that that relationship between what it is you're actually, spending that money on versus what it is you truly value. And I think it's also important not to like overanalyze it. Like I'm definitely not someone that like has a budget and like has to stick to it and like, be very close in like what it is I budget and like what it is I actually end up spending. It's just like being mindful of the decisions you're making, I think is just so important. And but not like overdoing it too. It's just like so much of a balancing act to it too.
Yeah, it's allowing your again, like man, I can't remember who it was. I heard on a podcast years ago. This lady, she said that she keeps her needs small so her wants can be outrageous, and I thought that was pretty cool. Like again, it's what everything you do in life is there's trade offs in everything you do, and you are making decisions consciously or subconsciously to uh, choose something, and there's opportunity costs with everything. And you really a big part of this is being cognizant of what am I voting for right now with my time and my money and my relationships and my talents. What's the opportunity cost of this? I'm working in a job I hate. Okay, and I wish I could start a business. Okay, well, what's the opportunity cost of not trying that? I'm broke and stressed, but my dollars are being spent on this other thing. That's where I'm not going to be like a cliche financial advisor who's like, you should make your own coffee. I make my own coffee with a really nice coffee machine. I have two nice coffee machines, one at my house and one at my office because I like making good coffee. It's way better than the coffee I can get at the coffee shop right below. My office is on top of two coffee shops. And I bought my own espresso machine because it's a lot better. And I save a fortune. I can justify it ultimately with how many espressos I drink a day. Um, but yeah, I'm not going to sit here and say like, don't buy coffee, but like think through like what is important to you. I remember years ago, I was talking with different financial advising firms, and there are two companies. I went through this long interview process and eventually went to lunch, like basically got the job and went to lunch with the owners. And on a couple of occasions, this happened. I pull up, I was driving sort of old beat up Nissan at the time, had a bumper that was not the prettiest sight to see. And I pull up to lunch and we'd start talking. I was like, hey Jim, when you work here, like our what we're doing is we're trying to convey this sense of success, financial success and wealth. So we really would want you to drive something nicer, a Lexus or a G-Wagon that's going to portray financial success. And at that point, I knew I could not work there because my job is not to portray a sense of financial success. My job is to help people use their money in the most efficient and effective manner to serve what's important to them in life. And for me, driving a fancy car is not important. Having more time to spend with my kids is way more important. Why would I drain and buy this thing that's going to have me have this massive car note when I can have that where I don't have this stress of having to go to work all the time or not being able to go on this vacation? It's like, man, like that's again, if we can peel back and say, why do I have this habit? Why am I doing this thing? If it means that you're buying coffee or going to brunch and that's really important to you, that's awesome. If it's, I do this thing out of autopilot, it's like, well, let's just stop and think through it. And yeah, if we can just become aware, I think it'd be really, really helpful with what we're doing. And again, like just being aware for yourself, but also on a relationship side of things. Like I remember a few years ago, I met with a family and I found out after multiple meetings that I was actually a last ditch effort before they got a divorce. They'd been fighting about money for years, and they thought, we'll talk with a financial planner. And what we realized at one of our meetings, they just broke down crying, and we realized that they fought about money all the time. And the last thing that came up was they're on vacation at Disney, and the wife, she wanted to go to Disney, but like make the sandwiches to take and no souvenirs and just experience Disney itself, but no other things. And the husband, on the other hand, like while you're there, you got to get the big ears or whatever it is, and the turkey leg and the funnel cakes and all of the stuff. And they were bickering the whole time. And it was like, you're so cheap. Oh, well, you're draining all of our money. What we realized though was taking a step back from this place of emotion driven hype to saying like, well, why do you want this? And for the wife, it was, well, gosh, like if we enjoy the simple thing of being here, but don't just lavishly spend on these other things, we could go on a second vacation. And man, that was really fun, but I want to do these other things with the kids as well and with you as well. I would love that. And the husband's perspective was, look, I didn't grow up going on trips. So if we're going to be here, I want to do it all the way because I really want this to be a special time. So it's sad because they're both coming from this place of I enjoy this. I enjoy being with you and
Mm-hmm.
our family, and I want to make the most of it. They were just communicating it in different ways, and their dollars were saying being represented in different manners. And it was again, there was mixed signals and mixed communication by how their dollars are being spent. If we could step back and say, look, this is important. There's a book that Kendra and I read a few years ago together. It's called the Strengths Based Marriage, and it's based off of Strengths Finders. Have you ever heard of Strengths Finders, Clay?
Yeah.
Okay, yeah, it's a sort of personality test, and it has like 20 ranks like your top strengths through like your weaknesses in a sense. And there's a book, the husband and wife, like Kendra and I both did this Strengths Finders test, and there's this marriage book you go through to talk through like how your strengths and weaknesses play off each other, and like the good part of the strength, each strength has its true strength and then has this like false narrative associated with it, this way it can rise up poorly. And that was a great thing because like I live in the future. Like all my strengths were like planning, futuristic, like long term. Kendra's are all about optimizing today. And I live in
Mm.
the future. And both of us came back and was like, she thinks I'm cheap. But for me, I look at this as like, no, I want to make sure we're able to do this long term. And I look at her like she loves spending money. She does. No, but it's like, no, I want to make the most of this now. And so having a context to place these conversations is really helpful.
Mm-hmm.
Yeah, long rant.
What you mentioned there about earlier about the job where they said, oh, you have to portray, this status and this level of wealth. I think it's amazing how what that tells you about like someone who acts in that manner. When you could analyze a company and say, what are the managers focusing their time and energy on? You could look at manager in your own business. Where are they focusing their time and energy? And I think so many people kind of go off into entrepreneurship because they just can't find an environment that like suits what their values are and what how they want to spend their time, how do they want to help people, or they don't want to play these political type games. And I think that's probably one of the reasons why you ended up going and starting your own business, because you know just the avenues that opens up for you and how you can design your life however you want, and then you can you know fulfill what you value even at a even higher level in terms of your family and your long-term financial goals. um, yeah, I think it's just sort of amazing how there's this sort of a balancing act within our capitalistic society where these bureaucratic organizations end up growing and they create these political games as a result of it, almost unintentionally in some ways, and then it leads to someone like you to take advantage of that opportunity and like fill the gap in the market where it's not being met, where you're not trying to go out and get a financial advisor that is flaunting their wealth or flaunting their car and such. So yeah, I love that you told that story.
Clay, do you have any? We've been everywhere today. Do you have any parting thoughts? Any episodes like, oh man, everyone should go listen to this conversation, or a book, or anything on your mind that you'd want to share that I didn't get to ask you about?
Yeah, I would say just like education is just like so important. It doesn't even have to be my podcast or any other podcast. Just like getting educated on, if you're interested in learning about investing in stocks or Bitcoin or whatever else, just like picking up books and like picking up podcasts is like so important. And as I mentioned kind of towards the beginning, is just like being humble in what it is you think like beginners, when they get into anything, it feels like they make these very simple assumptions and they essentially get themselves into trouble by taking these sort of mental shortcuts on how the world works or how they think the world works. Um, but yeah, education is just like so important. I'm sure it's a foundational sort of, it's a foundation of, what's led to your success, Jim, and all the things you've built. And yeah, and then just going out and trying to do whatever it is you're trying to do, whether it be, investing, starting a business, excelling in your career, and then just on top of that, education from the books and the podcast, just learning from your own experiences is all part of the journey, and it just makes it all fun. But yeah, if you want to learn about investing, check out We Study Billionaires. You might find a thing or two that's interesting.
It's good little show. Hopefully, I'll pick up a good audience eventually. We'll turn around. Now, I noticed when I was recording with Preston, I love he doesn't flaunt it, but I saw in the background in the corner, you saw the YouTube whatever color it was, the big plaque of XML listeners.
Oh yeah,
it's amazing what y'all have done there, and the amount of people y'all reach and the different shows and the community you're building. It's awesome stuff. And I've listened to countless hours of you guys and of your podcast, and getting to hang out with you. And Clay and I, we roomed in Miami a couple years ago for the Bitcoin conference. We accidentally got a terrible hotel right in the party district of South Beach, Miami. So that was fun. The guy blaring was like, "We will rock you" at like 2 a.m. You can hear him a mile away. And then a little different experience last month in Telluride in absolute natural bliss. So I love getting to spend time with you and keep tabs on you through your podcasts. Appreciate it.
Yeah, Jim, you've been a
awesome
absolute blessing in my life. And right when I joined TIP, I got connected with you. It's almost by fate, and we've been connected ever since. So you're a great friend, and it's great to know you.
Thanks for coming on, Clay. I appreciate it.
You bet. My pleasure.
Hey, thanks for listening to the Intentional Living Podcast. Now, today's show is simply entertainment and educational in nature. Do not take this as tax, legal, or investment advice. If you are looking for tax, legal, or investment advice, you should go talk with a tax, legal, and or investment advisor. But again, this content is simply educational and entertainment purposes. Thanks again for listening. We look forward to you joining us on the next episode.